All right, very good morning. Thursday, 22nd of March. Hope everyone is well. Just a quick overview. There's quite a few things to get through from a news perspective, such as a wrap-up of the Fed, some comments out of the US administration about China. We've got the Bank of England to look forward to as well later on today. And then I'll hand you over to Sam to look at some of the charts from a more technical perspective. So just getting straight into things. And let's talk about the Fed firstly. And what I just wanted to do was, I know most of you look at the FX market, so consequently euro dollar, and I just wanted to look at the price action and then some of the reasons and thoughts about what came out of the FOMC meeting last night, because of course, as expected, they executed the rate hike, which was at the time about 97% priced in by the market, so the sixth increase now in the interest rate cycle. You know, it's actually, when you actually step back for a moment and you think about all of the global central banks, you know, the US are way ahead of the curve comparative to the ECB, the Bank of England, the BOJ. You know, if you think of the ECB and BOJ still doing a large quantity of bond buying as part of their QE programs, whereas the Fed are actually tightening. That's quantitative tightening in addition to a sixth interest rate hike. So, you know, I think you have to put these things into a little bit of context, but let's look how the market did react last night. And coming in this morning, obviously, if you weren't around, you're looking at a quite substantially weaker dollar. And so consequently, euro dollar's risen from really around 123.5 level all the way up a full point higher. And what I really wanted to show you, and this is for the benefit, I guess, more for the newer traders, was this is euro dollar on a minute time frame. And the bit I really wanted to isolate here was this first, let's say, 4-minute reaction. Because this is where, I guess, as an inexperienced trader, your discipline really does get tested. Because what you tend to see is quite typical. There's a lot of information coming out. Last night was one of the more unique occasions, because not only were they anticipated to hike interest rates, you were looking at the statement that they release alongside that. You're also looking out at the summary of economic projections, which is quite a lot of information actually. You're looking at not just the dot plot, but you're looking at the core PCE or inflation levels and forecasts that they have, growth expectations, unemployment expectations, and then you've also got the press conference that comes thereafter. So what I'd say is that this is actually a fairly typical move that you get, which is really whipsaw price action. And ultimately what I guess experience teaches you is that unless you get a really outlying situation, so hypothetically that might have been, let's say the Fed don't hike interest rates at all, which was almost 100% priced into market, you're going to see an absolute collapse in the dollar, and the markets will flip on their head very quickly, because this is completely against expectations. So it's kind of like trying to hit market on the initial release is only really kept for those occasions, which obviously are very rarely do they occur. The bigger move, and this is often the case, comes after the initial noise, I would say. You know, think about it. If there is, what I've just suggested, lots of individual pieces of information to digest, how can you trade that without it being digested? It's just not a sensible trade to get into. And I think if you were new, what might have happened is you probably would have seen the rate hike. Okay, that's not important, but they've not changed 2018 to 4 hikes from 3. So therefore, it's dovish. Euro dollar's going up. I'm buying. And you're almost validated in that thinking by the fact that euro dollar did indeed rally. Only then for 30 seconds later, a complete reversal and lower. And then for you to actually have had the right interpretation, and we've had this kind of dovish reaction in the dollar over the long term. So really it's just about staying out of some of the mechanics and the algorithms and automated systems that obviously are hitting market pretty quick on that initial release, to then pick the solid levels, which with a lower amount of volatility is a little bit more tradable in that sense, and then trying to get hold of the bigger prevailing move, which you can see is kind of continued late into the US session. You get a second little lift as our Asian friends come into the market. And then as Europe comes in, another little third phased reaction. Now, whether or not this can maintain and we're going to continue to push higher, well, from a fundamental perspective, you could say that this is now priced in, given the dollar's fallen quite sharply and we've moved a full point higher in euro dollar. Do I think that just on the Fed alone that this is going to continue ramping up? Well, probably not. Why? Because we've just had some flash manufacturing PMI data from Europe, and both France and Germany have missed expectations. So that ultimately should weaken the euro in that reasoning, i.e. gives the ECB a lesser ability to remain hawkish, and so that counteracts then. You've got a slightly weaker euro now, and then maybe an oversold dollar in that sense. So it'd be interesting to see how it fares. What I'm saying here is that from the news that's occurred now, it's probably priced into markets. A couple of charts to quickly show you then. This is really the dollar reaction. So we've just discussed that. The dollar's taken what is a dovish reaction. And the reason why the markets have acted in a fairly dovish way, because if we look at some of the other charts quickly, not only are both the major pairs have traded higher, so cable consequently benefiting from the weaker dollar. T-notes, you can see here in the bottom right hand corner, so yields have fallen, i.e. treasuries have risen. The thing that surprised me really, because gold fits the narrative of a dovish reaction, i.e. moved higher last night and we found some support near to pivot, and we still remain elevated, about $11. It's equities, and equities actually did fall just a little bit last night. We've broken a support level this morning, had a quick run down through in the S&P of S1, but it has bounced, and in the recovery in the DAX even more aggressive. I think the equity one, as I said, was the one that surprised me, because if anything, basically we were all kind of amped up looking for the hawkish signals from the Fed, and the hawkish signal was supposed to have come in two forms: the inflation outlook and then the dot plot. Now if we go back to this chart here, what it's basically looking at is the PCE inflation, and this is kind of the breadth of different interpretations of where inflation could be. Now what was quite interesting was that if we look at the table of the summary of economic projections, you can see here core PCE, which is the kind of preferred measure of the Fed. They do see it actually above target, hitting 2.1% next year and the year after. However, even in spite of that, they don't feel the need to bump up the 2018 year-end estimate of 2.1% for federal funds rate, i.e. the risk of 3 rate hikes this year turning into 4 didn't materialize, even though they've bumped up the inflation outlook. So suggestive then that they feel comfortable that inflation is kind of hitting this peak, and maybe there's been a little bit of a breakdown of this normal Phillips curve of tightening of the labor force will consequently result in higher wages and net inflation. What was quite interesting is that 2019 did see an upgrade, as too did 2020, but the point being is that maybe some of this not as aggressive as people might have envisaged, particularly a few weeks ago. So overall, I would say my kind of assessment of what's happened here from the Fed, take away some of this short-term market movement, I actually think it was an excellent job by Jerome Powell. First time up, at the plate to bat, and I thought he did an excellent job. Didn't spook the market, and really the Fed, like I've said, are executing a continuous rate hiking cycle of which we can expect more to come through this year and next, and the market hasn't had an adverse reaction to a large degree. That's a job well done in my eyes, and the fact that he could be hiking but sounding dovish, so a kind of dovish hike situation which really epitomized Janet Yellen's chairmanship, if you like. It remains in place. The continuity is key, and the markets like that. And this kind of somewhat Goldilocks scenario of a very gradual approach means that I don't see any reason why this equity market should be more supportive rather than coming under some pressure. All right, moving on from that, a couple of other headlines I want to get you up to speed on, because I'm mindful I want to give you a Bank of England preview as well. This was some of the headlines from overnight. And I really don't think this is wholly surprising because people have known this was coming, given the rhetoric coming out of the US administration. But Trump is to announce a $50 billion in China tariffs, according to sources. So you remember he was kind of targeted in steel and aluminium, but actually the net result is that was going to affect Canada and Mexico the most. So quite influential for the ongoing NAFTA negotiations. But one of the interesting things here, and I think this really summed it up, there was a comment I did see in this article from one of the Chinese officials. So the Chinese Ministry of Commerce cautioned that the US taking measures is detrimental to both sides. The nation strongly opposes such unilateral and protectionist action and will take all necessary measures to firmly defend its interests. So again, it's not so much what Trump is doing, it's about the retaliation effect that people like China and Europe could have. There's been some noises already that China could counteract this by targeting surgically some specific goods, things like automobile imports, soybean, aircraft, chips, which all generally are coming from China into the US. So this is kind of ongoing, I would say, but it definitely needs to be watched. Markets have kind of though priced in this current state of play. One thing that did happen overnight was that Chinese central bank raised interest rates. Now, again, just for some of the newer guys, this isn't a shock because of the peg that the Chinese yuan has to the dollar. So if you actually look at it on a table, whenever the Federal Reserve increases, this is looking at the upper bound. Remember, there's a federal funds rate range from a lower to upper bound. So rates now at 1.75% at the top end of that. And you can see every time the Fed kind of makes a move, the PBOC in tandem tends to follow that pattern. So again, there hasn't been any shocks to this news, more of a function of the mechanics of managing their currency. So more of a necessity than something to manage the local economy. Another thing that's happened overnight, you might have witnessed a little bit of Aussie weakness. However, in the Aussie, it has found a bit of support around the pivot in the overnight session. Net trades about flat. So I'm not going to dwell on this too much, but Australian jobs rate edged higher, i.e. Unemployment in Australia ticked up to 5.6. This was unexpected. We were anticipating an unchanged reading of 5.5, so a little bit of weakness in Aussie overnight. All right, let's talk Bank of England. Central Bank roadshow continues. It's the turn of the Bank of England, but in all honesty, I wouldn't be looking for too much here. But a couple of interesting points to make you aware of. First of all, we're not expecting an interest rate hike. That's not going to happen today. What we are expecting is that to occur at the moment, as far as market pricing is concerned, is in the month of May, which after this meeting, there is no meeting in April. The next one indeed is that May meeting. So, as central banks tend to communicate, what a lot of the market will be looking for in the accompanying minutes that come out is, are they going to prep the scene a little bit more for the fact that they're going to hike in May? Remember, central banks like to prep the market so the market can position itself, so when they ultimately execute the hike in May, it creates minimal impact on market prices. That's the plan, at least. One of the key things here that might make the Bank of England sound a little bit more upbeat on proceedings at the moment, and this is really a battle of two halves. First half being, we had the wage data yesterday. And this came after inflation, after tracking really for the last 5 or 6 months up at around a 3% and even 3.1% briefly level, which is a whole percent above target. Inflation dropped year on year to 2.7%. And it was the first meaningful drop that we've had in quite an extended period of time. So the other thing that happened last night, wages are now rising at their fastest pace since the end of 2016. So if you think about the thing that's dogged the UK consumer, it's been the fact that they're getting poorer. Prices of goods are going up, but wages aren't improving. We've had, at least in this last month's data, the complete reversal of that. Wages are going up and prices are coming down. So therefore, does this then give the Bank of England a little bit more confidence that the pressure, this year-long squeeze on the household income situation in the UK is going to take a breather and they can fit in an additional hike? Remember, from a central bank point of view, one of the reasons why you want to be hiking interest rates is to rearm your ammunition, if you like, so that if we were to have a situation later down the road, we don't just have to turn the taps on or the printers on and print QE immediately. We can revert back to then we've got room to re-lower interest rates. So at this point in time, I think the wage number was quite interesting. This is what it looked like yesterday. It came in obviously at 2.8%. It was the biggest increase since the 3 months to September 2015, if you look at it on that period. Wage growth picked up in construction and in the public sector. Don't forget the public sector was quite key because you had Theresa May's government did lift the cap on pay for more than 1 million NHS workers on Thursday. So this as well should mean that wages will pick up over time, and we did see that reflected in the public sector's pay packets in the data from yesterday. The other side of this, of course, is political uncertainty. So the economics of the UK is improving, but the politics is still potentially a big barrier. Now at this point, we've had a framework agreement of a transitional deal announced at the beginning of the week. However, as of today, and tomorrow we're going to get the concrete EU summit kicking off. Now that's going to conclude with likelihood a more formal press conference late on Friday afternoon when they're going to outline that yes, an agreement has in fact been made. But EU's Barnier said yesterday a deal is not a deal until there's a deal, basically. So this by far is not completely done and dusted yet. What this means then is really two things. The kind of commentary so far from Brussels has been positive, and this is quite key if the Bank of England are going to execute a May rate hike. If this breaks down politically, which I'd say is a lower probability it's looking like at the moment over the next 2 days, that could scupper the ability for the Bank of England to act in May. Let's say baseline, they get a deal, the transition is secured and the political process of negotiating the exit of Europe continues. I think it's going to be quite difficult for the Bank of England to fit in another rate hike. Hence why people have penciled May as quite a key time. Other than May, if you start looking further down the line, it gets a little bit awkward for them to start raising rates because the political situation likely is going to ratchet up, i.e. come October, we're going to have the unofficial deadline for withdrawal in talks to conclude before ratification. Remember, October is kind of the deadline because at that point a deal needs to be on the table, and so then it can be ratified by every one of the national parliaments amongst the EU 27. So even though March is the exit date, October is where the pressure is really at. So it's either they get it in May or there's not going to be a rate hike at this point. And remember, markets are priced for May at this point. If this does change, then you're going to see a meaningful in the long term repricing of the pound, i.e. being weaker if they don't execute that. All right, quick look at the calendar for today, and I'll hand you over to Sam. You've got German IFO coming up shortly, so just going to wrap through this quickly so Sam can get through some level picking. You've had the various manufacturing flash PMIs, and they have been on balance weaker than expected, so do note that. IFO overall, this is what the chart for IFO looks like. It did come off slightly last time and has done in the last, really peaked about a month or two ago in some of the readings. Business expectations for sure. It's the red line we're most concerned about. But you can see even at a lower number, this still is really quite high in comparison to the last 10-year perspective. So I won't be looking for too much here unless we get a really bad number. Otherwise, on the calendar, Bank of England at midday, I'll come on and cover that. In the interim period, don't forget you've got UK retail sales at 9:30, so any sterling FX traders, you need to watch out for that as well. Later on in the afternoon, your regular weekly jobless data from the US, your market manufacturing PMI from the States, and then speaker-wise, keep an eye out for Brexit leaks from the talks. It's probably going to intensify more Friday as we get closer towards an actual deal being done and signed in that respect. All right, hand you over to Sam. Catch you guys later in the chat room. Thank you very much.
Good morning. Let's have a quick look over, well, we start with Euro this morning, following yesterday's announcement and conference. Let's move clear it up a bit. You can see obviously pushed higher into the end of the day, even this morning making a new high, albeit coming down a bit, and it's starting to get a bit messy. In terms of levels, well, to the upside, obviously, you've got, obviously, other than the high of the day, the high that we got back here on the 15th, beyond there, you've got the day before and R2 not a million miles away from 125, which sort of lines up not too far away from the high of that 14th there. I would be looking to get a trend line on here. You've got, let me just mark it up, coming from that high of the 14th. It's been quite well respected once, twice, 3 times, and then you had the breakthrough last night. Let me just get it a bit clearer down today. So I'd be aware if we do make our way a bit lower at any point, just to bear in mind this downward trend line, and 124 is in the mix as well around that point. So let me just mark that up as well. If it was to come down here, probably would expect that to be later on today. If it was to continue lower, I would expect some support around that point. Obviously the pivot is there below, but seems a bit middle of nowhere, and then yesterday's highs before the release looks quite messy. So in terms of looking for a trade opportunity, I think I would prefer it to come down a bit more to find a bit of support there. Looking at the lows, you can see today though, however, they have been a tiny bit higher. So again, I would be looking to get some sort of trend line on there to see if we can get respected on maybe the third test if we do come down. And it's a similar kind of picture to the pound here. Just wait for that to load up there. Let's put this on a bit of a longer time frame. You can see as well, you've had that breakthrough, and now we're at the highest we've been for, well, let's have a quick look, 2nd of Feb. So again, just getting this trend line on here. You can see we broke through that last night as well. Let me just clear it up, obviously, because it's the June contract. That's why it's looking relatively messy from the dates from before February. Lowering down the time frame a bit, I think if we were to get back towards the pivot, you could expect some sort of support. Similar for the euro with the low from last night, and then today we're sort of getting squeezed in a bit. Not a million miles away from that high of the day, but bigger things later on today for anything to do with the pound. And I'd just bear in mind the FTSE as well, which if we just switch over there, UK 100 has just been pushed up towards the pivot now as well. But yesterday was below that 7,000 there. You can see last time we were there was, well, we actually got there on the 5th and the 9th of February. So keep an eye on the FTSE today. You've got important levels just below from the low of the 9th, and then obviously the infamous day that we had at the beginning of Feb as well, and that on the 5th there. So not a million miles away from those levels on the FTSE, and on a longer chart, if I just put this on a weekly, you can just see how important that level of support could be for the short-term sort of future of the FTSE direction then. So important day today for the pound. Let's have a quick look over Aussie dollar, and as Ant mentioned, we did push higher, albeit to find a bit of support this morning on the pivot. I think in terms of levels to the upside, obviously the higher the day is one to bear in mind. I think from a technical point of view, I quite like the look of the R1 on the futures, because it marks up pretty much to the tick with the sort of afternoon high of the 16th. If we were to continue to push to the upside, bit of dollar weakness, and I don't necessarily think we'll get there today, but I would just bear in mind what was the low that we found on the 13th of March. I quite like the look of this area. I mean, obviously today marks up with the R2, but probably when we were to get up to that point, it would be a different sort of market level as well. But just 78.50 there, I quite like the look of that as a sort of an area where I would expect some sort of resistance from a technical point of view. If this was to get down to the pivot again, and you would imagine a couple more tests and you could get a breakthrough, you have the pullback that we had on the 16th, you've got the high of the 19th and the 20th, all sort of possible support areas to be aware of. And I think for a lot of these markets, if we were to see sort of return of a bit of dollar strength following the weakness last night, it could get quite choppy and messy around there. So in terms of sort of trading opportunities, it might just be better to sort of hold out a bit. Just having a quick look over at dollar CAD, which has caught my eye here. It's breaking to a new low here. Not that far away from today's S1, so we had a bit of a range. If we lower the time frame down to 15 minutes, you can see the highs tested a couple of times and the lows as well before finally breaking through there. So worth keeping an eye on the dollar CAD there and the Canadian dollar against a couple of the pairs. Oil, which pushed higher following the release yesterday and to levels not seen for quite some time. Just go back to the daily chart that we looked at, and I'll just reiterate it again of that break that we had. Let me just remove the pivots to clear it up a bit. You can see nice break. Oh, not that. You want the trend line there. Decent breakthrough. Yeah, and you can see we continue to go high. In terms of upside, we mentioned that yesterday $66 should be quite interesting, but probably more importantly, the high that we had on the 2nd of Feb there could easily be sort of tested today. But for now, oil just coming down a tiny bit. You can see in this sort of range, if you like, probably not the worst idea to sort of get a bit of a trend channel on there. Pivot, or just above the pivot, doesn't look too bad. You've got $65 handle, which is probably acting as the low of the day, but the pullback from yesterday, 5:30 around the pivot, looks quite good. You've also got some interesting support that we found around 3 o'clock before the further push higher yesterday. R1 following the release was a good classic opportunity. If you want to lower the time frame down, you'll be able to see that 64.43 on the futures looks a decent level as well. If we were to get a bit of a sell-off, another important level you can see here was the high of Tuesday, low of 12:30 yesterday, and could well be another good support area for oil to have a look at later. I'll have a quick look over at the DAX before going over to the US and looking at equity markets there. No real surprise to see the DAX has been up and down this morning, and we're pretty much back to where we opened the day. So in terms of levels to the upside, obviously pivot and higher of the day are in the mix, but probably you've got yesterday's sort of evening's high around there. So if you were interested in the pivot, stop has to really be above that level. But in terms of where that is trading, if you get a line sort of where the pivot is, you can see just how indecisive it has been though over the past few days. Key levels to the upside, you can see the double top from yesterday, probably the top end of that range, and then to the downside, probably looking really at the lows from the 13th, the 19th as well. Dow Jones to start with for the US. If we were to push up just a tiny bit more, you got yesterday's low here, looking on the hourly time frame. That could be interesting. The safer option obviously going for today's lows around about there, 24,705, but I would expect some sort of resistance, especially this morning around those points. Further push to the downside, S2 marks up very well with the low of the week, the low of the 19th that you have there, and if that was to go, you can see could get quite interesting on a break of the 7th as well, and then the door really does open to the downside. S&P is going to be quite similar in terms of yesterday's low is going to be quite an important one, probably more so as it offered a really good level support on the, what day is it, well, Tuesday as well. So bear in mind that 27.12 and 3/4. Safer again using the previous lows of today if you wanted to, just around here. Nasdaq, and well, just before we go on to Nasdaq, S&P, you can see today's lows offered very good.
IFO headline in line.
IFO headline in line. Your squawk for the day running in line there. So no real reaction coming from that. Nasdaq, similar to the others, lows of the week acting as good support this morning. I think for the Nasdaq, safer bet is to wait for a push higher to continue the downtrend. The sentiment for this market at the moment is to the downside. Have a quick look over at gold to wrap things up. Pushed higher last night. We found a bit of support, as is the case really with the dollar pairs as well. Let me just clear this chart up and refresh it again. Levels to the downside, low of the day pivot looks quite interesting. I think anything below there it could start to get a bit messy, as was the case really from 6 to sort of, well, 8 last night. In terms of a bit lower, if we break through the pivot, I would probably look to leave it alone really. From the highs of the day, you can see we're worth getting a bit of a trend line on there as we're starting to get squeezed in, making lower highs. Break through the high though does open the door to the high of the 6th, and you've also got R1 up there as well. But gold price recently has been pretty choppy, I would say. Any questions, as usual, please do let me know. And of course, we'll be on the mic throughout the day.